Okay, so let's start today. So today's lecture will be based on chapter 16. Before we actually move on to the class, let's look at what we did in the previous class. Let me share my screen soon. Okay, share screen. So we go into OWL. So we do have chapter 17. Like I believe I posted 2 videos, and this is where I'll be uploading the videos. So I do have week 1 here. Well, I haven't uploaded it yet, but I also did have a few videos on. Let me go and show you. Were you able to access the videos? That's my question. On working capital. Okay, so there are 2 videos available on working capital management. And 15 of you have viewed at least one of those videos. And this has 12 views. So some of you were able to find it. So this covers chapter 20. So chapters 19 and 20 in your class are complete from your textbook. And we will be moving on to chapter 16 right now. And this is essentially week 2. So chapter 16 covers debt policy. And we'll be covering debt policy today and maybe even a little bit in the next class. So without further ado, let's actually get started.
I'm sorry, I have a question.
Yes.
Will you post the solution of the mini case from chapter 19 to OWL?
I don't know if I have a mini case, but I'll see what I can do. Like, I might discuss something. I might post a separate video about it.
Okay, thank you.
And I also have a question regarding the question 20 in chapter 20. Will you post this solution for that as well?
Question 20 and chapter 20?
Yes.
But for that question, for question 20 on chapter 20, we have to work through 16, 17, 18, and 19. It's a follow-through question.
Yes, I understand, but I need an answer from that to compare to my solution because I'm not sure if I'm right or wrong.
Yeah, me too.
All right, I'll see. So I made note and I'll try and post some selected solutions. Yep. So,
Thank you.
So yeah, that's chapter 19 and 20. The quiz, I'll be posting the quiz today. Okay, so let me open the syllabus quickly. So the first quiz will be available today. So we finished chapters 19 and 20. So today we'll be starting with chapter 16. And by the end of the week or by early next week, I'll be posting a quiz based on chapter 16. And maybe I'll finish, maybe I'll wait for a quiz till we finish chapter 17 as well. And I'll do a quiz on chapter 16 and 17 together. But today or at the latest by tomorrow, quiz 1 will be available and I'll send an email. The quiz will be available through OWL.
How long before we have to complete them? Like, when is the due date?
Typically, you'll have 1 week.
1 week? Okay.
At the max, I think you'll have 10 days.
Sir, I have a question. So how many attempts do we have for the quiz?
Quiz, you'll just have 2 attempts.
Just one?
So this one, normally I give 2 attempts, but that one's like harder through the software. Here, let's say 2 attempts.
Okay, thank you.
And how long will the quizzes be available on OWL for?
I think you said you have a week, right?
Okay, sorry, thank you.
Okay, let's get started with chapter 16. So chapter 16 deals with debt. That's my, so remember this formula? I think so. This is a refresher. What is this? This is the weighted average cost of capital, right? So everybody remember this formula? So what is this formula again? Are you able to see my screen?
Yeah, we can
Yes.
see.
Yeah. So what's the formula for WACC? Who remembers it? You have something called this. So what is this? Come on, guys. All of you guys, most of you scored A in my course in 3310.
Weight of equity multiplied by the rate.
Yes. So this K is cost of equity, or you might know it as like, I don't know, RE, plus weight of debt into cost of debt. And then you have something like 1 minus tax rate, right? So what does this tell in some sense? What is, and BAC stands for weighted average cost of capital. Okay. So here, your overall cost of capital, this means this is the cost of capital of all assets, if you could try and think about it. Okay. So all these assets in some sense are financed by equity and debt, right? So this goes into your simple balance sheet problem. You have a bunch of assets on one side, and these assets are funded, I don't know, by equity and by some mixture of debt. So typically you call that like liabilities, but whatever, let's just simplify things and call it like debt and equity. So all these assets in the firm, which is either cash or inventory or PPE, property, plant and equipment, machinery, whatever, like, and then the rest could be thought of as like patents and whatnot. All these assets, in some sense, they generate cash. Okay, and these assets initially, for a new firm, these are funded by equity mostly, and sometimes firms tend to borrow debt in order to buy more assets and use these assets to generate cash and bid for positive NPV projects. So this is what happens in a typical firm. Okay, so let's actually look at some examples. So this chapter in some sense deals with like, well, how much debt do you actually want to have? And what is the optimal amount of debt? And what are the risks and benefits and like problems and incentive issues and who fights for what? And it deals with a lot of governance and some theory as well. And this, at least in the 80s and 90s in finance, was one of the most studied areas of finance in some sense. Like from late 70s and early 80s. 80s were the decade of studying debt and finance for the most part. And the interest has kind of come down because we kind of know a lot about how debt affects. And now people are going into smaller and smaller areas of debt financing. So this is known as the capital structure. A firm's mix of debt and equity is known as the capital structure. Okay, so typically this is just known as in terms of debt ratio. So debt ratio is pretty much the overall amount of debt divided by, in some sense, firm value, right? Or this is known as like debt to assets ratio. Debt divided by total assets. Okay, so this is the debt ratio, and this tells you how risky or how much money, what percentage of the assets were financed through debt as opposed to equity. Okay, so now shareholders, in some sense, want the management to choose a mix of securities that maximize, in some sense, firm value, and sometimes that will involve choosing debt in some sense. So let's look at a quick example. So let's try and work out something. This is from your textbook. I'm not sure if all these textbook examples are actually given to us in some sense, right? So let's actually go to a simple spreadsheet and let's do this. Okay, so let's look at a simple firm. So this one has, let's see if the textbook has it actually. Oh, this one actually has it. So this is table 16.1. Okay, so let's look at this simple firm. So for now, let's simplify things, right? Assume there's no tax. And why did I talk about this tax in between initially? So in this weighted average cost of capital, we did talk about in chapter 13, I don't know, a year ago for many of, well, for most of you, or maybe even a year and a half for some of you. Whenever you think about this cost of capital, it was advantageous to borrow debt, right? Why was it advantageous to borrow debt in some sense? Well, the advantage comes because you get some sort of like tax benefit. So that was what we kind of talked about. So if you're not sure, try and think about like a simple, I don't know, revenue. So the firm makes, let's say, $100,000. And let's say operating like after all costs, so sales, general, and administrative expenses, plus cost of goods sold, plus, I don't know, depreciation, whatever. All these costs together, the revenue is $100,000. So all these come to around $80,000. And your overall operating profit, in some sense, is $20,000. Okay, so let's look at a simple example here. And so this firm, let's say the firm has $1 million in assets. So the assets, in some sense, is 1 million. And this firm, it can be financed by equity or debt. So if it was all financed by equity, so then what will be happening here? So then the firm will, in some sense, pay some sort of tax, and then you'll have some sort of net income, right? So this tax might be, let's say, something simple. Let's make it 25%. So tax would be $5,000, and net income is $15,000. So this is the simple equity statement. Now let's look at the same kind of financial statement, except where the same assets of $1 million is done 50-50, financed 50-50 by debt and through equity. So how will this look like? So give me a quick number. So the revenue is going to be $100,000 again. The cost, everything is going to be $80,000. The operating profit is going to be $20,000. Okay, so now let's make some simple assumptions on debt. So this debt is $500,000, and this $500,000, let's say the interest on debt is 10%. So that means $50,000 a year. No, that's 10, right? My math is failing me, guys. Tell me. Can't think straight today. 0.1 into 50,000, $500,000. Yeah, that's $50,000. That's way too high. So let's choose a different number. $20,000. Let's say debt is, I don't know, no, it's still negative. I want a positive number.
Sorry,
What?
Prof, we cannot see what you write.
Oh, sorry. So I'm just trying to figure out an interest rate on debt which would make sense. So let's make the interest on debt as 2.5%. Okay, so this is the annual interest on debt. So if your annual interest on debt is 2.5% and it's 2.5% of $500,000. Okay, so 0.025 into $500,000. So that will be $12,500. So you'll have to pay an interest of $12,500 every year. So if your operating profit is $20,000 for a firm which is financed 50-50 by debt and equity, the interest alone will be $12,500, and the net income would be $7,000. Okay, so these are your two scenarios in some sense. So what would you prefer? Let's see. Oh, there's some people here. I'm unable to see my Zoom meeting here. Last week it was present, like 4310, and this week it's gone. Like, I don't know what's happening in my Zoom. So I'm unable to change the settings because I have to keep manually admitting people, and I need to change the settings such that they're not in the waiting room before they come in. Well, anyways, I'll figure that out later. So here, these are your two scenarios. So this is an all equity scenario. And then here it's 50-50 debt and equity. So what would you like to be in? If you are the business owner, think of this $1 million business. That's all the assets are, right? It's not that much. So think of, I don't know, you're a contractor, you know. So a contractor can easily make $100,000 of revenue a year with $1 million in assets in some sense. So this is how your firm is set up and financed. Which scenario would you want?
All equity, because it produces more net income.
Okay, so Jose says all equity. Who wants to counter that? Or does everybody agree with him? Do we have an alternate?
I want more debit.
Go ahead, Finn.
Like as much as possible, like controllable debit, affordable interest payment, something like that. Yeah. So
Fan's argument is like, well, as much as possible, if you are able to borrow debt, you know, and as long as the interest payments is low. So
wouldn't you have to look at like the inflation rate against the like interest rate to see if the value of money, it's worth it to take a loan if you don't need it?
No, that doesn't matter, right? Think of that as like the cost of borrowing right now. You know? So let's look at the simple scenario. The interest on debt is 2.5%, which is fairly low. It's, I don't know, close to today's environment if you could try and think about it, right? So if a firm wants to borrow, honestly, today's environment will be more expensive. So this is a very simple. So the cost of borrowing does make sense, but let me give you a simple thing, Jeremy. So here, we did talk about this weighted average cost of capital, right? So what's the relationship between what's the cost of equity? How do you find out the cost of equity in the weighted average cost of capital? Right, so this is given by the capital asset pricing model, right? So what is this RF? This RF is the
risk-free.
Okay. Okay,
B
so,
is beta.
Yeah, so B, this is like your beta. And this, in some sense, RM is return on market. Right? So this risk-free rate typically is proxied by some sort of treasury bill. Okay, so right now the short-term interest rates are 0. But typically, if you want to look at a firm, you look at a firm from a long-term perspective. So instead of treasury bill, in practice, treasury bonds might also be used, like a 10-year treasury bond. So the interest rate on a 10-year treasury bond is what, around close to 1% now. Okay, so inflation expectations in theory affect the cost of equity as well as the cost of debt. Okay, so this should not matter too much. Inflation, well, it matters, but it doesn't, unless you have to make an argument that, well, inflation only affects the cost of debt in a different way, and it does not, it affects the cost of equity in a different way. But as long as you come under the assumption that, hey, they roughly affect debt and equity in the same way, it should not matter too much to your debt to equity decision.
Thanks.
Okay, so in some sense, we are starting to slip into this valuation review as well. Maybe this won't take that long. So maybe you guys will be very prepped next week. So was there any counter arguments to Fran? Like where he says, like, will you prefer debt or equity? And what does the rest of the class think?
I think it would depend on the cost of debt versus the cost of equity. If one is incredibly high, then why would you want to go with that type of funding? You would want to swap over to the one that has a lower cost.
Okay, so let's try and put some values to these so that we simplify and make our decision easier, right? So the cost of debt here is 2.5%. Okay, so let's assume a simple scenario here where even taxes are not available. Right, so let's make taxes 0 for simplicity. We could always quickly add taxes later. So here, if taxes are 0, you're getting $20,000 under the all equity scenario for the net income, and here you're still getting $7,500. And here, when you try and think about it, the cost of debt is 2.5%. Let's make the cost of equity as 7.5%. You know, so this is your spread. There's a 5% difference between the cost of debt and cost of equity.
If
Anyone
this
else?
is the
Yeah, anyone else choosing debt, by the way?
if this is the case, then debt would be the best option because it reduces the cost of borrowing and financing your business.
Okay, so you're saying debt would be the best option because it reduces the cost of financing and borrowing your business. So what will change? Okay, Jose, I'm going to keep trusting you. So what if this is 5% now? Would you still choose debt now? What if it's 4%? Okay, so you get the idea. So I feel like none of you are making a decision because it's hard to make a decision in some sense, right? So first of all, would this scenario be possible? It's 1.5 cost of equity.
I don't think it's possible
Yes, it's not possible. You're correct, Fran. Why?
because the investor will put the money in the bank rather than give it to the company because bank have a higher rate.
Exactly, right? So think about it in a typical firm when it goes through bankruptcy, right? And if you have a low cost of equity, why would anyone even bother starting a business? So that's Fran's argument. Nobody will start a business, right? So typically, when you try and think about, have you heard of the show called Dragon's Den and Shark Tank and things like that? They look at 20, 30%, 40% return. So when you're starting your own business, you want a high rate of return in some sense. That's what, otherwise you might just put your money in your bank and nobody will start businesses ever. So even when you're trying to think in terms of bankruptcy, when a firm goes under bankruptcy, even here, the operating profit, after you get the operating profit, money first goes to debt holders, and only then money goes to the equity holders. So this is the hierarchy in terms of who gets the money first. So even in terms of bankruptcy, the debt holders get the money first. Right? And then at the bottom of the barrel, you have the equity holders. And even here, before bankruptcy, the lawyers get the money first. And then you have some sort of like unpaid wages and so on and so. And any other, then like the government comes and gets their thing, taxes, and then come like senior debt holders. And then you have some sort of junior debt holders. Something like that. Like this is not always thing, but these three typically get their money first. And then finally you have like what you have preferred shareholders, and then you have like common shareholders. Okay, by the time these people get some money, there's almost nothing left for these people whenever firms typically go through bankruptcy. But this is how you get the money. So in some sense, the cost of debt is always less than, not even less than or equal to, is always going to be less than the cost of equity. So this is a rule in some sense. So this is one of the things which you always have to check over here. There have been times in your exams when I've had this rule being violated over here. This rule will be violated and someone will have the cost of debt greater than the cost of equity. I wouldn't even read the rest of the solution or answer. If that happens, it'll be like an automatic wrong, and I'll just like give a 0 there and I'll be moving forward. So that's what's one of the gradings which happens. So everybody has to check for this sort of solutions here. So here, in terms of whether it's one, so this is not possible. So we're going to look at 7.5% in some sense. Let's look at a simpler example. So I'm going to try and agree with Fan over here in some sense. They're like, well, debt can be agreeable to many people in some sense, right? So, but this debt, let's try and calculate the return on equity. Why is debt valuable here? Well, what's the return on equity here versus what's the return on equity over here? So return on equity over here is going to be $20,000 divided by $1 million. Okay, and that's what, 2%? It's abysmal, but whatever. I should have made the whole thing bigger. And here the return on equity is so it's 75 divided by 5,000.
1.5%.
No, sorry. What's happening? Okay. Why can't I get this?
Should just be 75 over 500.
I don't know, this calculator app is weird. Or making a, I'm just going to go to Excel. This 1.5% seems off. Is this 2% over here? .2%. That was the difference.
Shouldn't the top number be 20 there? 20 over 1,000?
Oh yeah, sorry. So it's 2 divided by 100. I'm getting something wrong here. My calculations aren't working out. I don't know why. Or maybe I picked the wrong numbers. This is 2%. here 75 divided by 500,000. 75. Okay, so I think I chose the wrong numbers, but anyway, let's go to a better example. Maybe your textbook still has a good example. Let's see if I can get a proper example. Here. Okay, so let's go through this text, or let me try and see if I can find a better example. So this is an example of a firm which has, let's say, $1 million. And it has, let's look at the normal scenario alone. And so under $1 million, the share price is $10 if you have 100,000 shares. And the operating income is $125,000. And the earnings per share accordingly is 1.25 in some sense. So if you're trying to think about the return on shares is going to be 12.5%. You have $1 million in assets, or you have $1 million in equity, and you're earning $125,000 in operating income, and you're getting 12.5% as your return. So now if you try and do a similar same firm over here, but now you have half the number of shares because half the firm in some sense is given by debt and is financed by debt. In the same scenario, you get $125,000. So these people use better numbers in some sense. The interest is $50,000. And then equity earnings are $75,000. And your earnings per share is much higher. Okay, so just to give you a quick comparison, the earnings per share is 12.5%. And here, the earnings per share is 15%. Why is this scenario happening? 15% if you get debt, and here you're getting only 12.5%. So this scenario happens because here the $125,000, you're getting the same operating profit, but you're putting only half the money in some sense. And anything beyond this $50,000 payment, okay, I think I understand why I'm failing. That's okay in our example. So anything beyond this $50,000 interest in some sense is pure profit for equity holders. Whereas here, you're required to come up with $1 million of your own money in some sense in order to generate this $125,000. And here you're generating this $125,000 and you're getting a much higher return. So if you want to try and give a quick calculation over here, let's look at the textbook example. You're generating $125,000. In the first scenario, you get to keep all of that with $1 million of capital, and that's why you're getting your 12.5%. In the second scenario, out of this $125,000, you're paying away only $50,000, and you get to keep $75,000 in profit in some sense. Okay, so you are getting to keep a much, you put in only 50% of the money as an equity shareholder, but you get what, 75 divided by 25? What's that ratio? You're getting to keep 3/4 of the money in some sense, right? I don't know, I'm still getting this. So you get to keep 60% of the money earned, even though you put in only 50% of the money. So this reason is why debt can be very, very attractive for many equity holders. Okay, and this is the reason why a lot of firms prefer debt. And think of the same scenario in better times. In better times, when during a boom scenario, you have $175,000 in operating income, but debt holders still get only their $50,000 in interest, right? And equity holders get to keep most of the gains over here, $125,000. And the return on equity is 25% over here when you have debt in the firm. But on the other hand, if you try and think about it this way, the return when during a slump scenario, this return on shares can be very, very low, and you get only a 5%, whereas in the all equity, you could get 7.5%. So this was the scenario I ended up, unfortunately, choosing to showcase as an example, where during bad times, the return on equity for debt can be even lower, whereas here was what, 1.5%? During bad times, the return on equity when you borrow debt is pretty low, but during good times, the return on equity can be very, very high, 15 compared to 12.5, and during over here, 17.5 under all equity and 25% under debt, right? So imagine you're a shareholder of this company, you buy just one share. In the previous scenario, your earnings per share was 1.75, and here your earnings per share is 2.5. So that's a big, big jump in terms of how much money you are entitled to. Okay, and this reason is why a lot of shareholders sometimes might want the firm to actually take on debt. Any questions so far? Okay, so under what scenario is debt better and under what scenario is equity better? Well, this graph kind of starts summarizing that, right? So the yellow portion over here is your equal proportions of debt and equity, and the blue line is your all equity firm. And here you're graphing the relationship between the operating income and the earnings per share. So we had something very, very similar, which we used to call degree of operating leverage. Right. So the degree of operating leverage was in some sense the ratio of like how much fixed cost do you have, right? So this was related to the amount of fixed costs you have in the firm. So if you are a firm with high amounts of fixed costs, that means you have high operating leverage. If you have very low amounts of fixed costs, that means you are very, very flexible. So a similar effect is observed with debt in some sense. So if you have a lot of debt, you're forced to make some sort of payments in some sense. But as you start more and more becoming more and more profitable, this is your payout in terms of debt versus equity, and this is your payout in terms of all equity. So up to $100,000 in operating income, being an all equity firm owner is actually better. But once you start going beyond the $100,000 in operating income, getting debt is actually starting to become beneficial. So this relationship can be seen even with our example. So our operating income over here in the made up example, which I just with numbers, was $20,000. So that's why your return on equity was actually greater than the return on all equity was greater than return on 50% equity. And so there the income was around over here. And over here, the return on equity is actually much higher once your operating income starts going beyond $100,000. And so now you try and think about the debt versus equity battle is like, if you foresee your firm to start doing very well in the future, or if you're already doing very well right now, and if you're an all equity firm, maybe it makes better sense for you to borrow some money for some of your assets for expansion, rather than just keep funding it through equity. Okay, and also allowing using debt can help you grow faster rather than just have all equity. So this ties into your chapter 8 and chapter 19, where you have the concept of the internal growth rate and the sustainable growth rate in some sense, right? So we did realize that the internal growth rate is always lesser than the sustainable growth rate, because under the internal growth rate scenario, you are not borrowing any money at all. Whereas under the sustainable growth rate phenomena, you can grow at a higher rate because you are allowed to borrow money in order to fund your expansion. You're just not allowed to change your capital structure. Okay, so long story short, this is the idea of leverage. Leverage can be a double-edged sword where you could get much higher returns, but when things go bad, you start losing real bad. So that's the big concept about leverage. And that's why a lot of firms start going bankrupt during recessions. So the number of bankruptcies start increasing during recessions because the overall spending in the economy is down. And during these terms, these firms do not earn high rates of return. And then suddenly they go down. But among all this stuff, right, two researchers, the 60s, I believe, Modigliani and Miller, okay, they came out and said, well, there's the market value of the company does not depend on its capital structure. Okay, the overall value of the company does not depend on the capital structure at all. And the value cannot be increased by changing the mix of debt and equity to finance the company. So these people say this, well, we just saw over here, during a lot of times, it's as a shareholder, you would want to get a higher return on equity, and therefore you would want debt in the firm. So this is more valuable. This yellow line over here is way more valuable to you as a shareholder than this blue line over here. And of course, you see the benefit in debt. I see the benefit in debt. But they came out and said, capital structure of a firm, whether you use debt or equity, does not matter. So why is this the case? Well, let's quickly look at this sort of scenario in some sense. So there's an example of, I don't know, let's say, we went to a store yesterday, and me and my wife, and we got a cherry pie, you know, and so we're like, hey, how hungry are you? How do you want this pie to be cut, right? Like, well, it's a small pie, so let's cut it into, I don't know, 4 quarters. And then imagine if someone suddenly, like if I suddenly say, no, so I don't want just 2 slices. I'm feeling really, really hungry. Let's cut it into 6 parts, right? Or you could use the same example as for pie or pizza. These are 2 most commonly things used. The number of slices in a pizza does not affect the value of the firm. It only affects the value of the pizza, like in some sense, whether the pizza is bigger or smaller. That's all that matters. The number of slices does not matter. How you finance the firm does not matter. But of course, this works only under these particular assumptions. Okay, the capital markets have to be well functioning. That means it's fairly efficient. If there's some sort of inefficiencies, investors can spot it. Everyone can borrow, trade securities without restrictions. This is becoming more and more true because nowadays we have Robinhood apps in the US. In Canada still sucks in that regard, and I wish we have something similar to that. Wealthsimple is a poorer, weaker alternative, but that's the best we have, I think, for Canadian securities. Investors can borrow and lend on the same terms as firms. So this is a big assumption, but some investors can do this. Capital markets are efficient, and there are no taxes in some sense. So these are some, under these sort of scenarios, the value of the firm cannot be changed by changing the mix of debt and equity. So we showed how debt can be advantageous, but now let's try and think about an individual investor. Instead of you investing over here, let's say instead of you investing all $1 million into this firm, and if the firm wants to make the shareholders richer, so here the shareholders get, let's say, 12.5% return. And if they borrow debt, they get a 15% return, right? So the management says, well, obviously the shareholders get a better deal if you borrow debt, right? But the shareholder does not care about that. Why? Because if I'm able to borrow money, I would not give all the money to and invest in this firm. If this firm is more valuable in some sense, I could replicate this whole scenario by borrowing debt from the same firm. So this is an example. Let me drink some water. Okay, so let's say the firm has zero debt. That means the firm has not restructured. So the investor can put $10 of her own money, borrow $10, and buy 2 shares at $10 a piece in some sense. Okay, and if your borrowing cost for these $10 is the same rate as the borrowing cost for this river cruise firm, you have effectively replicated the same return on investment, right? So this is where you have something known as margin. Has anyone traded stocks? If you have traded stocks, you know, sometimes you could borrow money. You have the idea of story, right? This is a big losing $700,000. Okay, so this is a teenager. He was able to borrow up to $700,000 from the Robinhood app, and then pretty much, I think I don't know, he might have, I don't know if he killed himself or, oh, there's an article which says that, but this happened. Like this person should have never been allowed to borrow that much money. So initially borrowed, I don't know, the $2,000, used the $2,000 and turned it into like a lot of money. And Robinhood, I think, closed those loopholes, but still they were able to get a lot of money and trying to increase their returns, but the negative happened in some sense, and the double-edged sword unfortunately killed that person. So leverage is the idea where you could borrow money from your assets. So this is the idea of where you have line of credit, and anyone who's a homeowner knows this. Like your parents often sometimes even would borrow against your home equity line of credit. So this is something which even I have, and I have borrowed money. If you have a huge home repair, you already invested a lot of money in your house. For your huge home repair, you might borrow against your home equity for line of credit. So borrowing is allowed a lot, and investors can borrow money and invest in shares in order to replicate this whole scenario. So here it's 5, 15, and 25, which is very similar to the firm changing its capital structure to 5, 15, and 25 in 3 different scenarios. So the investor does not have to depend on the firm to borrow half its money in order to give this sort of return structure to equity investors, when the investor can do that by himself. So this is why the Modigliani, they pretty much say debt is irrelevant because the value of the firm is unaffected by its capital structure. Okay, any questions so far? No? So,
hi, Professor Romani. I do have a question. Hello?
Yeah.
But it's not about the course material. It's about because I'm an international student. I'm just wondering, and I received your email for transforming the participation mark. So I'm just wondering, like, so I have sent you an email. Do I just wait till you reply it?
Yeah, I'll just reply to your email.
Okay. Thank you. Bye-bye.
Any questions relevant to the topic? Okay, so, and this shows you an idea of, again, how this whole thing happens. And the idea of 2 kinds of risk to a firm, okay? So the firm borrowing money does not affect the operating risk or the business risk. The underlying risk of the firm, in some sense, does not change because the ability to get positive NPV project has not changed because you borrowed money. However, the financial risk of the firm, in some sense, has increased a lot. Okay, so what is this financial risk? The financial risk of this firm, in some sense, is the risk that you are not able to make this $50,000 in payments. So here, even under the slump, you're still making a positive return. So you're in some sense safe here. You'll always be able to make this $50,000 in payment. But imagine where this operating income falls under $50,000, and then you'll start to have trouble paying this $50,000 in interest. We did see the question of, I believe, in your textbook, in chapter 20. Here we go. Was it chapter 20 or I believe it was chapter 20. Let's go here. Maybe it's chapter 19. Has anyone read the concept of LA gear?
The concept of what, sorry?
The company LA Gear. So it's a shoe manufacturing company which was able to keep existing just because they had a lot of cash. Well, anyway, it's not the most important. I thought it'd be nice to show, but I can't remember where it is in your textbook. So whenever you have your operating income dip below the interest payments, you are, in a sense, dipping into your cash balance from your assets in order to start paying out this interest in some sense, right? Your cash balances start reducing. So firms do not become bankrupt because they had a bad quarter or a bad year. Firms become bankrupt when they are unable to make this $50,000. And this $50,000 is usually not paid when the firm has low cash balances in some sense. So this is the benefit of having some sort of sufficient liquidity. And we'll talk about this concept a little bit later down this road. Okay, so this is the debt irrelevance, which we talked about. And another way to try and think about this whole idea of leverage is this concept in some sense. So this formula is the proposition 2 in some sense. So the return on equity over here is dependent on this debt to equity ratio. And this is also related to this cost of equity over here. So now let's try and redo this WACC. Okay, so return on assets, the weighted average cost of capital in some sense is the same as return on assets. So the return on assets is the weighted cost of equity, weight of equity into cost of equity plus weight of debt into cost of debt. And here we did say it had 1 minus tax rate. But let's take away taxes for now and for simplicity's sake. And we had the Modigliani and Miller assumptions. So from here, you could try and find out the cost of equity. And when you try and put this together, so weight of equity into cost of equity is RA minus WD RE. No, it's R. Yeah, so this becomes this. So RE is RA by weight of equity minus WD by WE is cost of debt to cost of debt. So you get sort of this formula, and then you make some algebraic arrangement, and this weight of debt by cost of the weight of debt by weight of equity is your debt to equity ratio. And once you rearrange using some algebra, that becomes this. How do you rearrange here? Multiply the whole side by I don't know. I'm sure I could do it given enough time, but I don't want to waste your time. So if you try and take out debt to equity ratio together, whatever, you'll figure it out. So once you go from this equation, this becomes or equity depending on the debt to equity ratio. So this is their proposition 2. So in terms of remembering things for this class and in terms of testing for exams and quizzes and stuff, the proposition 2 and proposition 1 are very important. So the first proposition 1 just tells you that debt is irrelevant. And the second one tells you, well, the cost of equity is directly dependent on the debt to equity ratio. So the cost of equity increases when the debt to equity ratio increases. And the cost of equity decreases when this is low. And if a firm has zero debt, our equity is the same as our assets. Okay. And just to get you some terms, unlevered firm refers to an all equity firm. Okay, and when a firm is said to have levered, it means you have debt is present in capital structure. And I believe I told us in the first class of 3310, half of finance is just knowing these terms and understanding what these terms mean so that you're able to communicate with something. It's almost like the language by itself, if you try and think about it. It's just knowing a bunch of vocabulary. It's another language without having to learn a new grammar structure. So this is another visualization in terms of how the return on equity is actually affected. So the return of assets do not change, but as you take on more and more debt in terms of debt to equity ratio, the rate of return for equity keeps increasing. Okay, but now if you try and think about the proposition 2 over here, when you come to this part of this kind of idea, they say that, well, as you start increasing the rate of return, as you start incorporating debt in your balance sheet, equity becomes more and more expensive because you start facing higher and higher risk of bankruptcy. So if you over here, if you add an additional column over here, which is like extreme slump and extreme boom or something like that, under this idea of extreme slump in some sense or recession, where your operating income is only $25,000, you will be bankrupt over here. So because taking on debt becomes more and more dangerous, as the debt to equity ratio starts increasing, the cost of debt will also start increasing, and accordingly, the cost of equity will start decreasing in some sense. And the return of assets remains the same. Okay, so this is an example which Fan said initially. When I first asked, which one do you prefer? Do you prefer debt or do you prefer equity? He mentioned that, well, I prefer debt up to a certain extent if it's safe debt. So at low levels of debt is virtually deemed as risk-free. So Microsoft, Apple, a lot of these big companies have a bunch of debt. But since they have so much cash balances, this debt is in some sense turned risk-free. But as they start increasing their leverage ratios, that becomes more and more risky. And this equity becomes, it starts flattening in some sense. And this is why the proposition 2 says that the value of the firm does not matter because as you increase debt, the cost of equity in some sense increases. Okay, so let's quickly maybe look at some examples.
Hey, Prof. I'm pretty sure my buddy's in the waiting room. Could you admit him?
Okay, yeah, thanks. I believe Pulkit's in India, and for this, a recording of this video will be available in case you're curious. So on OWL, I did upload a couple of documents, resources. So in handouts, I uploaded this document, chapter 16. So let's try and do this first question over here. Okay, this is question number 14 in your textbook. If you have it. Okay, the common stock and debt of Northern Sludge are valued at 70 million and 30 million respectively. Okay, so return on equity is 16% and return on debt is 8%. Okay, so now you have this question of Northern Sludge issuing additional $10 million and uses this money to retire debt. So what happens to the expected return on the stock?
Can you repeat the question, sir?
It's the same question over here, whatever is available in the document. I just read it out. So this is the question. Or in other terms, what is the new cost of equity?
So we calculate the return on assets first, and then we use that to calculate the return, the cost on equity.
Yeah. So what do you have? So you have your return on assets is weight of equity into cost of equity.
Right. So that's 8% times 30 over 100, and 16% times over 70 times 70 over 100.
Okay, so what is this value?
Is 0.136, so 13.6%.
Okay, so you have this value. Now someone else, if you could try and.
So we use the formula, the equity.
Yeah, so thanks. I'll give someone else an opportunity to.
Okay.
Sorry, what's the question you're asking right now?
So in case if you don't have this, please download this document, chapter 16 from OWL.
So with that.
So, and that's the first question from that chapter. Okay, so this is the question over here. What happens to the expected return on the stock? That exactly is the question in some sense.
Wouldn't it increase because you're reweighting more of it towards equity?
From a qualitative perspective, you say it increases. Or does it increase?
Wouldn't that be 80 over 100 multiplied by 16 plus 20 over 100 multiplied by 8?
I can follow you in the best way, but first of all, Cameron, does this actually increase? What makes you tell that it increases?
Because you're taking 10 million of, or you're increasing the equity by 10 million and decreasing the debt, where the equity has a 16% return and the debt has an 8%. So it's higher weighted towards the equity. Wouldn't that automatically mean that the expected return goes up?
No. So it doesn't really happen that way. So let's try and think back in terms of slow to load. Proposition 2, right? So here, if you try and think about this, the debt to equity ratio, what happens to that?
It goes down.
Reduce.
It goes down. So if it goes down, the return on equity should go down in some sense. So you are trying to think in terms of like, well, the firm is borrowing more money and the firm, the return on equity is 16% and it's higher. And so therefore the firm is spending choosing a more expensive method of financing is your thought process, which in many scenarios is true. So the point these researchers are trying to say is the cost of equity and cost of debt are usually not fixed. They're flexible. It depends on time. It depends on the capital structure. Is what the point. So the 16% is not set in stone. The 16% is always variable and it depends on this debt to equity ratio. The only thing which does not change is the return on assets, is their argument, right? A firm's business risk does not change. And the return on assets tend to remain constant. And from all these figures also, if you could see, the return on assets is always a flat line and does not depend on the debt to equity ratio. That's their point. And it's very intuitive in some sense, like the business and operating risk does not change. So the only way for you to get higher returns or lower returns is to use leverage as an equity shareholder, is what they say. And this return on equity shareholder, as long as you keep changing this debt to equity ratio, it changes. And so this firm, in some sense, had a higher level of debt to ratio, and it suddenly lowered it by issuing some sort of stock. And so it should reduce. That's the first expectation. At least if you believe that assumed changes in capital structure does not affect risk of debt and there are no taxes and so on. So, okay, so under these assumptions, under the Modigliani and Miller assumptions, what happens? And the new calculation is what I'm asking. So Ch16 said, well, we know that the return on assets does not change. So let's calculate that first. So that was her intuition. And we did calculate that the return on assets is 13.6. So now we know that the return on assets do not change. Let's calculate the new return on equity.
Why is return on asset equal to WACC?
Sorry?
Why is return on asset equal to WACC, weighted average of cost capital?
So think of forget the it's cost of capital, right? Assets is pretty much the stock of all capital.
Okay.
So if you try and think about it in some sense. So the weighted average cost of capital is pretty much always it's the same concept of return on assets.
Okay.
So for the new cost of equity, now you're going to have common stock as 80 million.
Yeah.
And you're going to have debt as only 20 million.
20 million.
Right. So that's what's happening here. So new return on equity in some sense is going to be return on assets,
which is 13.6 plus that is now 20 over 80.
Okay, so now this would be 13.6 plus
20 over 80. Minus.
Okay, so what's this value?
It's 15%.
15%.
15.
15.2%, right?
15 or 15.2?
13.6 plus 20 over 80
My
multiplied.
bad, it's 50 and I miscarried the digit.
That's fine. 15, that's it, straight?
Yes, it's 15.
Yes.
Okay, so 15% is your new value in some sense. And as you can see, because the capital structure decreased, it was 16% and it decreased to 15%. So this is the point which they're trying to illustrate where if you have low levels of risk, in some sense, you do have reduced things. So let's try and look at actually some examples from Yahoo Finance. Right, let's go and look at Apple. Oh, the computer is so slow. Supposed to have 8 gigs of RAM, but when I'm opening Zoom and like Dropbox and Outlook and Word and connecting them all at the same time. So Apple's financials, if you try and think about this, it has around what? Let's look at its debt. Okay, so total debt, it has around $112 billion in debt. And the total amount of assets it has is around $300 billion. But this is in some sense very deceiving in some sense because they have around, not current liabilities, total assets, let's go to current assets. They have around $90 billion or something like current assets, like 90 plus 30, they have around $140 billion roughly in cash alone, $130 billion. And the amount of debt is something very, very similar. Why do they have this much cash in some sense? Because they generate so much cash over here. They generate to the point of around $100 billion in gross profit or $67 billion a year in just pure profit. And then they pay some interest and whatnot. So for some firms like this, right, over here, if you try and think about it, if a firm has low levels of risk-free debt, the debt is assumed to be virtually risk-free. So a lot of people trust Apple to be a better investment than what you could call like the treasury bills or government investing in like the government treasury bills and treasury bonds. And so a lot of these companies, I'm not sure if you've heard these term called like FANG companies or FANG Plus or FANG. So what are these firms? Have you heard of this term before? So F stands for Facebook, Apple, Amazon, Netflix, Microsoft, Google, in some sense, right? And they'll do this FANG plus, I don't know, Tesla. They might add Tesla here, you know. So all these firms are pretty much like the big, the big tech firms, you know. So the big technology firms currently are being priced almost like at very, very, very low levels of equity return, right? The return on equity, they have such low debt that the return on equity by firms are like they're not getting anything. So they're all investing in these sort of like big tech firms, and these big tech firms are used as almost proxy for debt right now because debt is not paying anything. The interest rates on debt worldwide, whether you go to like US or China or India, everywhere it's fallen by 3 or 4% points compared to a few years ago. And it's fallen by like maybe 4 or 5% compared to 15 years ago. Right? Interest rates in probably China, if someone can tell me, were probably around 7% or 8%, and now it's probably around 3%. Right? Interest in China, 7% in like mid 2000s is what I would say. And so these are things which actually happen, and the cost of equity for very, very big firms is probably only 4 or 5% over here. Okay, so this is an example without taxes. Now, what happens when you actually add taxes to this mix, right? So when you do add taxes to this mix, we do have to pay taxes before you actually receive the money in some sense. Okay, so here, if you have zero debt, in the same example as before, if you have zero debt, your overall net income before you're receiving $125,000, and now you're receiving only $81,000. But under the other scenario, if you have to pay debt, the overall combined income for debt plus equity holders is 98,000 versus only 81,000. So this extra benefit, 81,250 versus like 98,000, the extra $17,000, approximately $17,500, is the benefit which almost always goes to the equity holders. Okay, and this is a big benefit. Why? During higher tax rates, when you have high amounts of taxes, that becomes all the more beneficial. Okay, so this is something where you could find out the present value of this debt. And this present value of this debt can be thought of as this annual tax shield divided by the cost of debt. So where does this formula come from? Okay, so the present value of a tax shield is pretty much whatever you're paying as interest, in some sense, multiplied by the tax rate, interest into tax rate divided by cost of debt. So this is known as the present value of tax shield, right? And why is this present value of tax shield? Because you're assuming that firms last forever, right? And whenever you have something called forever, what is the present value of a perpetuity? It's going to be C by R. It comes from your chapter 5 formula. The present value for perpetuity is C by R. And because of that, this C over here, what is this benefit cash flow just by borrowing debt? Well, that's from interest rate into the amount of interest you pay into the tax rate. Because whatever you're paying as interest in some sense over here, if you're paying interest of $50,000, this $50,000 is deducted from your operating income before you pay tax. And that's the net benefit of borrowing money. So American households get an additional benefit. And I initially thought Canada had the same thing, but thankfully we don't have to have the same thing. Housing prices are crazy enough in Canada as it is, and we don't need this extra. So for Americans, when they pay their mortgage, the interest part of their mortgage, in some sense, it's tax deductible. Mortgage is part tax deductible in US, whereas here it's not tax deductible in Canada. And this is why mortgages make a lot more sense in the US compared to even Canada. But that didn't stop Canadian house prices from going through the roof. But this, because you're paying this extra money, you're getting this benefit for shareholders. So in this scenario, if you try and think about, this was the size of the pie before, or the pizza. And whether you have all equity or whether you have debt and equity does not matter, right? But now you are adding the same pizza, but you're adding an extra slice to it. And this is known as the present value of tax shield. Okay, so it's almost like you're getting an extra slice if you borrow debt. So this is under no taxes. Whether you borrow debt and equity does not matter. With taxes, it's like you're getting an extra slice. And the value of that extra slice in terms of value of the firm is given by this present value of tax shield. Okay. And this is a very, very big advantage in terms of actually borrowing debt. And for this reason, in some sense, so we talked about this already, and this present value of tax shield, you could actually compute it out, right? So this interest rate, so we put it as corporate tax rate into interest divided by the annual debt, our debt. And once you cancel out, it just becomes corporate tax rate into the overall amount of debt which you borrow. Okay. So now this leads to a new firm. So before, the value of a levered firm becomes the value of unlevered firm plus present value of tax shields. Okay, so this is the unlevered firm, or even if it's an all equity firm. So this is the value of VUL, and this is VL in some sense. Okay, so this is going to be the value of UL, value of L, plus TC into D. I hope this formula is there somewhere. And similarly, your return on equity from the previous formula gets updated over here. The only difference is you are adding the corporate tax benefit effect over here. Okay, and the capital structure under this scenario is how you're actually getting this. This is where the overall weighted average cost of capital comes from. And this is where this 1 minus tax rate idea came from for your WACC. Okay, so now that you know that taxes have some sort of benefit, you could try and think about, well, what is the overall idea, or what is the overall effect of corporate taxes in some sense, right? So here, now that you're saying that, well, as soon as you start adding taxes, and if debt is cheaper, the more and more money you borrow, the weighted average cost of capital starts coming down, right? So now if you try and think about this weighted average cost of capital, it's almost becoming like the cost of like the return on assets in some sense, or the cost of financing these assets start coming down. And the cost of equity keeps increasing and debt remains constant at 6.5%. So this is how the value of the firm actually occurs. So the value of the firm, there's no proper figure. Oh, there it is. So as you, here it starts saying, as you start increasing more and more debt, the value of the unlevered firm is the orange line, but the value of the levered firm will keep increasing. This is under tax rates. And the slope of this line will depend on the tax rates. If tax rates in Canada are 15%, and tax rates in the US were much higher at 28% before. So debt had, American firms were much more incentivized to borrow more money because they had a higher corporate tax rate. Whereas in Canada, since you have lower corporate tax rate, firms did not want to borrow as much money. Okay, so and depending on the tax rate of the firms, it might be more beneficial to borrow money. Okay, so questions so far? So, but in reality, this does not just keep happening. Like you cannot just say, well, if this is the case, all of us will just borrow like this no tomorrow. We'll just keep borrowing money. Nobody will put their own money in, right? Well, value of the levered firm is increasing. If I borrow more money, that's what this relationship says. That means you just keep borrowing more and more and more money and keep increasing the value of your firm. But clearly this does not work, and there are limits to that borrowing. And what are those limits? Well, that comes in the idea of what is the cost of financial distress. So the cost of financial distress in some sense is as you borrow more and more money, people will not be willing to lend you money in some sense. This cost of financial distress will be like the cost of bankruptcy, because there'll be one potential scenario once in 10 years. It happens once in 10 years where this scenario happens, where your operating income, in some sense, your operating income is less than the amount of interest which you actually have to pay. And this means you are you go under bankruptcy or you're forced to raise money under very, very poor situations. And these sort of issues completely destroy the firm. And because the firm might not cease to exist, as it borrows more and more money and as it has to pay more and more money in interest, people start recognizing that the fact that debt does not stay constant. So after only up to a particular level, this cost of debt remains the same. So there's some optimal amount of debt under which debt is perceived to be risk-free or fairly low risk. And beyond that, the cost of debt starts increasing a lot. And the cost of equity also starts increasing. So the overall weighted average cost of capital is minimized at this point in time. And that's the ideal amount of debt which you need to hold in some sense. And over here, if you try and think about it, well, normally the value of the firm keeps increasing and increasing, but after you start going towards some particular point of debt, the overall value of the firm starts decreasing because the cost of financial distress becomes much, much higher. And this, in some sense, is the optimal amount of debt for a firm to have, okay? So this value is very, very different for different kinds of firms. So which kind of firms do you think has more value? Do you think Apple should borrow more money, or do you think a real estate firm should borrow more money? Do you think Intel should borrow more money, or do you think Bed Bath & Beyond should borrow more money? Right? Should Shopify have a lot of leverage, or should General Motors have a lot of leverage? So think about these questions. So typically what happens is who borrows money? Like, has any one of you borrowed money from a bank? Have you gone through that experience, right? So, but when you go and try and borrow money, when you buy a house, banks are almost always readily willing to give you money as long as you have some sort of income. Why? At any point in time, if you don't make your mortgage payment, they'll repossess the house and they'll sell the house in the open market to someone else. Right? They're fairly guaranteed on their return and you're low risk because the house is a collateral. But when you ask for a personal line of credit, they'll be charging interest rates of like 8%, 10%, pretty high interest rates because it's not backed by anything in some sense. And you could declare bankruptcy and not pay them. So because of these sorts of risk, it's a lot higher. Credit card debt in some sense is 22%. And for certain people, it's 30%. So the general rule of thumb in some sense, any hard tangible assets, firms are able to borrow more. That's why real estate firms typically have high levels of leverage and they're able to borrow more. And auto industries, they have those manufacturing plants and metals and whatnot. They are able to borrow more money than a software firm which just has, I don't know, patents like BlackBerry. Like, I don't know, it's hard to ascertain the value of these assets in some sense. And those firms find it much more difficult to borrow money. So hard tangible asset firms with a lot of property, plant, and equipment typically tend to have higher leverage. Like Hydro One, Canada, can borrow so much money. Any power plant, London Hydro, Toronto Hydro, Hamilton Hydro, whatever it is, they have lots of debt on their balance sheet because they have hard physical assets and their cash flows are very, very stable. So these firms have high levels of leverage, whereas software technology firms have very low levels of leverage. And this cost of financial distress can come in many forms in some sense. The bankruptcy costs are one thing. When a firm goes through bankruptcy, you have to hire lawyers, and there's a lot of infighting between individuals. There's so much infighting because the equity holders might not want to, they want to get something. The senior debt holders would not want to. Some of them will have an incentive to keep the firm running. Some of them will not want to have the firm running anymore. So there are lots of issues, and you have to hire lawyers, and these fees typically are between 10 to 20% of the firm in some sense. Indirect costs of bankruptcy. If there's a result where Air Canada is going to go bankrupt, or WestJet is going to go bankrupt, what are you going to do? You're immediately going to you will never be booking any future flights with WestJet. You'll be booking all your flights through Air Canada for a foreseeable future till you're confident that WestJet is going to come out of bankruptcy. So these sort of issues actually happened in many places. I remember when this was even not too long ago, in 2009, 2010, Air India, this was an Indian airline, it's a nationalized airline. And they were so inefficient that they had a bankruptcy scare, and customers immediately jumped ship. Nobody was booking flights with Air India for the next 6 months. And those are 6 months worth of revenue permanently lost in some sense. So same thing, during the financial crisis, General Motors and Chrysler cars were not selling very well because they were not sure if they were going to come out of bankruptcy properly. General Motors, so what's the ticker symbol, right? So General Motors, GM, it earned a nickname. The government had to come bail it out. So they were being called, I don't know, their nickname was like Government Motors for a little bit, because the government of, which is back then the Obama administration, they owned the firm in terms of equity. They actually sold it. They made a profit from GM's investment, but nonetheless, they had to step in. And it's unprecedented, right? In some sense, it's like the Quebec government is owning Bombardier in some sense, a huge portion of Bombardier right now. So these sort of issues, this indirect cost of bankruptcy. So Bombardier is also struggling because nobody wants to, first of all, they have a bad reputation and they're not sure if Bombardier can service their coaches, trained coaches or airplanes, I don't know, 10 years from now, because nobody's sure Bombardier is going to exist 10 years from now. So these sort of issues actually happen. So the trade-off theory, in some sense, is as to what is the optimal amount of debt. The optimal amount of debt is where you're balancing this tax shield, present value of tax shields with the cost of financial distress in some sense, right? So this is something which actually happens. And other things, employees, as soon as your firm is starting to do poorly, employees would jump ship. You know, the Bombardier guy will be like, hey, can you take my resume at some other technology firm? Or you're working for Pratt & Whitney, you're working for Boeing Corporation. You'll start applying for other places. You know, all your suppliers, anyone who's supplying raw material, before they'll give you a 30-day leeway. You know, they'll supply the material and you have 30 to 60 days to pay. And suddenly they'll start requesting cash on delivery. So all these sort of issues have a lot of cost, and they are, these things are the cost of financial distress in some sense, okay? But there's also hidden costs of financial distress. So if you try and think about it, it's actually draw the firm. Okay, so try and think about this as payoff to shareholders. Okay, so this is the amount of, this is operating income. Let's not put it as operating income, let's just make this value of the firm. Okay, so the value of the firm, let's call this idea as the value of debt. Okay, so what triggers bankruptcy in some sense? Whenever you try and think about the overall, what you could call the value of the firm, if value of firm or value of all cash flows, present value, PV of all cash flows is less than the value of debt, this triggers bankruptcy in some sense. So bankruptcy is also known as Chapter 11 in the US. I think it might be called the same in Canada. And this is bankruptcy. So whenever the value of the firm is less than the value of debt, the firm can potentially enter bankruptcy. But there are many scenarios where the value of this firm might be temporarily less than this value of debt. Why? Because the interest payments might be very low, even though the firm has a lot of debt. And if the interest payments are very low, and they might not have to, most of this debt matures 3 years from now, but it's not maturing in the next year. So the firm has a few years in order to get this value of firm from here to here in some sense, right? So if you try and think about the payoff for this firm, the payoff to the firm's shareholders is going to be that, and then it increases. Anything, as soon as you cover the cost of debt, you start receiving a positive payoff. So that this is the value of equity in some sense. So, but if the value of the firm is only over here, right? Let's put some simple numbers. Let's call this value of debt as, I don't know, 10 million. And the value of the firm currently is at 5 million. So let's say you have a positive NPV project over here, which could give you $3 million. Will you accept this project? You're the owner of the firm. So this is a question to all of you. There is a project, there is a positive NPV project of $3 million.
You accept.
You accept. Who will not accept?
Wouldn't you not accept? Oh, you would under normal circumstances, but because you're so highly leveraged, you can't afford to take on the initial investment.
No, ideally you have. Let me phrase that in a different way. You're saying you will not accept because it's not accept, but this is a fairly safe project where $3 million, let's say under a good scenario, and you'll get only, let's say, negative $100,000 if the scenario is bad. Let's assume there's only like good and bad scenarios. Okay, so this project, in some sense, has a very positive NPV, but it's fairly safe. But there could be another project where it's NPV, where you could get $10 million if good, and negative $5 million if bad. Right, so this is a very risky project. Let's say, let's make things simple, 50-50%. Right, so here NPV is 0. Right, or let's not even make it 5 million. Let's make it a negative 8 million. Here NPV, if it's 50-50, is going to be negative million, right? Whereas here, the NPV is going to be 2.9 or something, or 2.8, something like that.
How is it negative a million?
2.8, sorry, no, I put 90 thing, like it's going to be like 1.4, 1.5, 1.45, something like that.
Prof, how is it negative million?
Or negative 2 million?
I think positive $1 million for that one.
Whatever this value is.
5 minus 4 is 1, not negative 1.
I need to change the number such that it becomes negative 1. So let's make this negative 12. Or negative 14, whatever it is.
Yeah, now it's negative 1 if you make it 12.
That's what I wanted. Okay, thank you. So negative $1 million. The goal is there's a negative NPV project here. Long story short, there's a negative NPV project here, and there's a positive NPV project here. Whatever this positive value is, 1.5. I'm just rounding things up. Something like this. But here, if the going gets good, you get $10 million, right? So if you actually get some money from this, if you add $10 million, you're somewhere over here. $5 million goes to the debt holders in some sense, and the extra $5 million goes to the equity holders. The overall NPV is still negative $1 million though, right? So if if it's bankrupt in some sense, the value of the firm goes all the way down to zero, but the shareholders don't care. Even if whether the value of the firm is $5 million or whether the value of the firm is $0 million, the shareholders get nothing. Whereas even though this is a safe project and it's a positive NPV project over here, the firm value will go only a little bit over here. But all these gains in some sense go to the debt holders. None of these gains go to the shareholders. So whenever you have some sort of bad scenarios, shareholders can gamble, right? It's almost like saying, well, let's take whatever money we have left, go to Vegas and gamble, go to Macau and just like gamble and try and hit the jackpot, get some professional gamblers, hire them and ask them to make money for us in blackjack and just try and win money. And hopefully that'll save the firm. That's what they're aiming for over here. So these sort of issues tend to happen a lot with firms where there's a conflict between debt holders and equity holders. So these are also some sort of costs of financial distress. They are tempted to play games at the expense of their creditors, the shareholders, right? They don't care about the maximizing the overall market value of the firm. They care about maximizing the value of their equity, right? You don't care about the value of the firm. You care only about your payoff, right? So Donald Trump will burn the world if he can become the president. He doesn't care that half of America is burned. You know, if he wants to rip America into half rather than, and maybe even stay president for the southern half or whatever it is, he'll do it. Like at least he attempted to do it. I mean, who knows? He has 2 more days. Probably he won't, but at least that's what he's trying to do, probably. So these sort of issues tend to happen and conflict between debt and equity holders. And these are some big ideas in terms of cost of financial distress. There's a lot more theory in this, not a lot more, there's a little bit more theory, but let's stop with the theory. I've been talking too much. Let's do one more problem. Let's try and do question number 2. So when I was doing my PhD, I had to read all the original papers, like the research papers of Modigliani and Miller, figure out how to do those proofs and derive all these equations by hand. I probably forgot half of them, but I could go and look it up again. It will happen to you as well. Most of these things which you study, you'll forget its tiny details, but if you could remember the overall concept a few years from now, that'll be good. So this is one chapter where it actually makes a lot of sense to read the textbook or any textbook, even if you don't have this textbook. So this question, so 10,000 shares. All of you have this question, right? Like, so this document, so I'm going to move this document away. So it's all equity finance. So this is the market value of equity. It's also the value of unlevered firm. So it's 1 million. Okay, so this is an easy problem. So let's go through it fairly quickly. So here, you will be buying back stock. So that's the most important thing. So when you issue $200,000, so your capital structure initially was assets and equity. So when you issue $200,000 of debt, you are buying back stock. So your overall amount of assets are still 1 million. But now suddenly you have, I don't know, $200,000 of debt, and you have $800,000 of equity. And in the other scenario, you have $400,000 of debt. Debt to equity ratio, you could compute straight right away. So here, debt to equity ratio is going to be 20 divided by 80. Here it's going to be 40 divided by 60. So you ask for EBIT. It's going to be $90,000 or $130,000. And you asked if high debt or low debt is preferable. So what will be the interest over here?
20,000.
90,000. So taxes, no taxes. So tax is 0. So net income would be 70,000 over here. Here interest would be, I'm guessing, 40,000. And here would be whatever, 90,000. Same thing. No, it'll still be 20,000. Yeah. And here it's 40,000, 40,000. Okay, so now that you have the net income, you need to calculate the earnings per share.
Sorry, the second net income should be 1,100,000, not 90,000.
No, so this is the low debt scenario. Under low debt scenario, I'm having 90 and 130, but the EBIT can be 90 or 130. And under the high debt scenario, it can be 90 and 130, right?
I think she's trying to say the net income of the second column shouldn't be
Oh,
90,000.
I get the old, okay. Okay, yeah. So now that you have the net income, what's your earnings per share? Well, before you do the earnings per share, how many number of shares do you have? So you have the debt equity.
10,000 shares.
So you had 10,000 shares initially. And if you're repurchasing $200,000 worth of share, how many shares will you be buying? You're roughly repurchasing 20% of the firm. So you'll have 8,000 shares left. Whereas here, under the high debt plan, the number of shares you have will be 6,000. Okay, so can someone give me the earnings per share?
Is $8.75 for the first one, and $13.75 for the next one.
For high debt plan, the first one should be 8.33. And the second one is 15.
15.
Yes.
That's it? No decimal?
No.
Someone else getting the same value?
Yep, I can confirm all of those.
Okay, that's good. So now that you have your earnings per share, like what do you want to say in terms of like, is the high debt preferable or low debt preferable? Right? So here it seems to kind of feel like, well, it depends on the personal preference. If you are very risk averse, I guess the low debt is preferable, like you do not like the volatility. But since you're being fairly profitable under both scenarios, and the EBIT is $90,000 to $130,000, where it's much, much higher than the interest in some sense, high debt seems to be more preferable in some scenario. Okay, so, but now let's do part C. Now suppose the EBIT is $100,000. And interest should be 20,000, 40,000. Net income would be 60, sorry, 80 over here, 60,000 here. So earnings per share over here is going to be 8, I believe. No.
That'll be $10 for earnings per share.
And here also it will be 10. Okay, so this in some scenarios is asking like what is the EPS under each financing mix? Why are they the same in this particular case? Now let's here try and go back to just some of these figures. Over here, when you try and think about an all equity versus the debt to equity over here, if you put these some sort of like simulated values in spreadsheets and try and adjust the debt to equity ratio, you could get multiple lines. And one of these lines is this way. Another line can be something like starting from this point over here and can go all the way this way. You know, something like above the all equity beyond a particular value. But the point at which they intersect in some sense is going to be $100,000. So going back to this problem over here, if you expect your earnings per share to be greater than $100,000, it's better to go through this high debt plan. If you expect your earnings to be less than $100,000, it's better to be in the low debt plan. Okay, so your previous answer, we obviously like to be in the low debt plan when the income was low, and you want to be in the high debt plan when the income was high. So depending on what you foresee your income over the next year or next 2 years or 5 years average in some sense, you could accordingly determine whether you want to have more debt or less debt in some scenarios.
But
Okay.
why is it that they are the same though?
So this is the point. Okay, so this is, I'll just draw this figure. Okay, so let's think about, this is the debt to equity ratio. and this is the earnings per share. So the under the debt to equity ratio, like let's say low debt to equity ratio. For the low debt to equity ratio, this might be something like this. Okay, so for the high debt to equity ratio, it might be something like this. And this is the point at which they intersect. And this point is 10 in our scenario. Okay, so, and this depends on the operating income. This corresponds to an operating income of $100,000. So anytime you have an operating income of greater than $100,000, your EPS will be higher under the high debt scenario. Well, this is not going to be debt to equity ratio. Let's make this. So this is the high debt plan, and this is the low debt plan. So anything beyond this $100,000, you get a higher EPS through the high debt plan, and anything less than that, you get a higher EPS through the low debt plan. Okay, so this is a simple question actually, but it's to try and explain this last part, that could be a little bit harder as to why is it same, or when would you prefer high debt and low debt? These sort of questions. That's it for class today. We will finish one question, or maybe we'll just do this mini case next class and solve a little bit more. And if there's any little bit of theory remaining, I'll finish that next class. And we'll try and work out a problem based on this, like the second parts with taxes included rather than just no tax scenarios. Okay, and let's try and talk a little bit about liquidation and reorganization. So I will stop recording right now, and I will upload the